Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng is up around 1%. The Taiwanese index also trading with gains of close to 0.5%.
Oil prices, they fell 10%. They're back. I mean, I think this morning when I looked, they were at about just under 100. We're about back to about $104 odd.
To that extent that they are not resolved, insist that their concerns are recorded in the minutes of the board meeting.
It's going to be a reflection and an assessment of HDFC Bank's internal processes, I would imagine.
22,850, that's about 1.5% higher. The Nifty Bank is up about 1.6%.
Oil marketing companies have not fully passed on the global benchmarks yet, so next increase that will come on April 1st will be watched out very closely.
Company yesterday announced a price hike in two phases between April 10th and 21st. And the price hike across the portfolio would be 6 to 8%.
And if you take a look at the Nifty, that's down from the highs. Where you take a look at the rupee, that has reversed course again after the initial appreciation that you saw.
Well, there is definitely a recovery which is taking place from the day's lows. So currently at around 22,852.
The promoters are put together. The entire family holds about 75% stake in Cello World. And they would be looking to sell anywhere about 51% of that stake.
CDSCO has intensified monitoring of the supply chain of GLP-1 based weight loss drugs.
500-point uptick on the Nifty as we speak, 1,500 on the mid-cap index, and the advanced decline ratio, which was at 1:20 in favor of declines yesterday, is in favor of advances at 5:1.
Okay, that is the day so far, and the market, of course, up 400 points, not 500, but not bad either. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Rima. Rima, hi.
Hi, rebounding quite nicely. It comes after many days of losses for our market. We've come off about 100 points from the day's high. The high today was 23,057, so about 100 points off from the highs, but still holding up very nicely. 2% gain on the benchmark indices, 1 hour to go. The mid-cap index is up almost 3%, 2 3/4 of a percentage point. The advanced decline ratio holding quite nicely, and broad-based gains visible today. Banks are finally doing well. The Nifty banking index is up 1,300 points. It's also the expiry today.
It's also the expiry, absolutely, Tuesday. But, the market wants to believe that what we have seen over the last, 16, 18 hours, basically, is the beginning of the end of this, conflict in the Middle East. I'm referencing that Trump tweet. And I think about an hour and a half back, there was another a social media post, or maybe it was actually a story, but it was in Israeli media, which essentially said that Iran's the new supreme leader wants to talk, wants to negotiate. Remember, but it was Israel. It was in Israeli media, reference to Saudi sources. The market, nevertheless, took off. From that point, it took off very, very sharply. But we've not really heard from people like the foreign minister or the speaker of the parliament in Iran, etc. People who've been regularly commenting have been in the thick of it over the last many days or so. So we'll see. But 400 points, there is the expiry factor, I'm sure. But of course, there is also the other factor, which is that, for the first time, at least from President Trump, we've heard de-escalatory comments. Whether it'll happen, not happen, as I said in the morning, watch the headlines, but of course, also watch happens on the ground with regards to the actual fighting and whether there is, a slowdown in that, and that will give more confidence to the market. Well, let me just quickly run you through what's lined up here before we go any further. Key indices, of course, doing very well. Sectors, pretty much all of them in the green. Paint makers are up. Actually, Asian paints is up 4%. The others are up more like 1.5%, 2%. It's just a complete flip, right? When oil goes down, oil consumers do well. We'll, of course, also touch upon the IT services space as we inch closer to the quarterly results. And JP Morgan's got a note out. GMR Airports is another one which we will talk about. Kotak has got a note. So all of that here over the next 60 minutes or so. How should you position yourself is the question. Mitesh is with us with that answer. Mitesh, hi, good afternoon. What's your sense?
I believe, Prashant, that this market is going through what we talked about as a pullback, and we discussed 23, 120, 150 as the zone, which the Nifty needs to clear and close about to suggest that at least there's a temporary arrest of this declining movement, which has not happened as yet, but still watching it out. So that's the level on the upside. Otherwise, in case we fail that, if today and for tomorrow as well, we might come back to 22, 600, 500 zone at least. Having said that, I have one buy and one sell call right now. On the buying side is Infosys, which is a conditional buy. If it starts getting past 1300, buy with a stop at 1288 for targets of 1330. And JSW Energy is a sell with a stop at 495.5 for targets of 465.
Mitesh, after a long time, there is a buy coming in on an IT name, Infosys. It's just a rebound from oversold levels. Any thoughts on other IT names which you are tracking very closely? Because across the board, you are seeing a pretty good bounce back. So there is Latent Force, First Source, eClerx, Mastech, Emphasis, Persistent, all up 3-4% today.
IT, one, I think, very clearly was one of the first sectors to correct and therefore more oversold than some of the other stocks and sectors. Two, I think the rupee depreciating factor also kind of helps IT stocks. So keeping both these things into mind, and given the fact that the hourly chart was showing first signs of reversal, yesterday we had a buy on HCL Tech, today it's Infosys. I think that's where one trading space where traders can, possibly look at exploring some long positions, at least to counter the kind of shorts they might have on index and other sectors.
Okay, we'll come back to you, Mitesh. For now, let's talk about MCX shares in the spotlight. We understand from sources that SEBI-appointed CDAC has backed the proposal to permit FPIs in commodity derivatives. That's gotten MCX excited today. Yash joins in with the details.
Well, we had reported this exact story last week where we had spoken about the Commodity Derivatives Advisory Committee, or CDAC, meeting and discussing the proposal of allowing foreign portfolio investors, or FPIs, into commodity derivatives. Now, what we've been given to understand from our sources is that CDAC has given its approval. In fact, it's backed allowing, foreign portfolio investors in commodity derivatives market. What we've been given to understand is that now CDAC has asked exchanges to give suggestions in terms of what the regulatory framework around allowing FPIs in commodity derivatives could look like, and exchanges are expected to reply to CDAC with that particular framework. Also, what we've been given to understand is that CDAC has suggested allowing FPIs first in cash-settled commodities like gold and silver, and then going on to other commodities as well, like Brent, as well as base metals, is what it is currently considering. SEBI chairman also on March 2nd had alluded to this very development, which was expected in the next few days. Back then, he had said that they will consider allowing FPIs in options trading in commodity derivatives very soon.
And this is a story which, of course, we've been tracking for a while, as Yash said. Yash, thank you for that. Dharmesh Kant is with us, Head of Research at Chola Securities. Dharmesh, good to have you with us here. There's a 4% rally coming through, a 100 rupee gain. Any thoughts? First gold and silver, and then perhaps, agri, I think, is going to be a strict no-no. But other non-agri commodities, but gold, silver first, but they're also the most heavily traded, right? And perhaps an oil. Dharmesh?
Yeah, Dr. Prashant, thanks for having me for the show. It's a good step in the right direction, and it will add liquidity and more, solid pricing as far as gold and silver is concerned, along with oil. So, because of domestic bias, the depth of liquidity was not there, and it was more used as a hedging mechanism by large corporates. So, I think with retail participation and more FIs coming in, will add to the liquidity out there. As far as pricing is concerned, gold, silver, and oil is dictated by international pricing. So nothing, changes out there on the pricing front. But definitely good for the exchange, more revenues for them. And at the same time, since it will add more liquidity and depth to the market, good for the brokers as well.
By the way, Europe is absolutely flat at open. The CAC is 0.06%. The DAX is down 0.5% and FTSE is up just about 0.1%. But bear in mind, most of the European markets finished with solid gains yesterday because that Trump announcement about that 5-day ceasefire not attacking the energy infrastructure in Iran came during market hours when Europe was still trading. So there was a U-turn in European markets and the share prices there. But today, there is no follow-through buying. So opened up on the flatter side, negative for the German index. Just wanted to quickly update on that. But moving on now to Asian Paints. That's announced a 6 to 8% price hike across its portfolio, citing rising crude and raw material costs on account of the war. Manglam joins in with more.
Well, we got a great rule of thumb by the management of Berger Paints this morning where they said that for every $1 increase in crude, 30% of that is actually an increase in the raw material basket for paint companies. So a 40% increase in crude ever since the announcement or the tension started, that equates to about 12% increase in their raw material basket. So to that extent, companies have taken their price hikes. Raw materials account for 55% of the overall cost price for the company. So that explains the 6 to 8% sort of math. Asian Paints has announced this in two phases, one on April 10th and thereafter April 21st, to obviously, one, smoothen out the dealer risk, at the same time, maximize value and volume growth for the company as well, and not just give one jarring increase. All the other paint companies had already given a 2 to 3% price hike already, with another one likely with effect from tomorrow, and in some cases with effect from the 30th of this month itself. And Berger Paints themselves joined us and said that they are looking to announce another paint price hike on the April 9th day as well. But importantly, crude prices sliding overnight from the peak also is an additional positive. From the start of this war situation, most of these paint companies are down anywhere between 12 to 15%. So the fact that they were lower, and now that they've taken price hikes and crude prices are lower as well, all of that does well for them. Demand situation has been okay so far, with the companies citing no major problems. And the first quarter is something which is a bigger quarter for the paint companies. So let's see how this pans out. Macquarie has an outperform rating on target with a target price of 3,100 on Asian Paints, and that explains why the stock, after having fallen a lot, is currently up around 4.5%, among the top Nifty gainers today.
So tomorrow is around 1.5%. The one which is on the 30th of April will be another 2% possibly. So it will be 3.5% of coverage. And then on the April, possibly around the 9th or the 10th, we will have the balance about 3 to 5%, depending on where the things stand at that point of time. So typically in paint, we take in stages, that's how it has been always. And we are now going to take it. First stage will come in effect tomorrow itself. That will be part of the enamels and certain other portfolio in the waterproof range. And in the second stage and the 30th is, all the premium and luxury emulsions where we will take up the prices.
Dharmesh, solid company Asian Paints, but the stock hasn't done anything. The 5-year CAGR is minus 2% for Asian Paints. And now, of course, it's navigating this crude price increase. They're passing it on. High valuations has always been a concern. But what would you advise on Asian Paints?
I think it's more of a trading pop-up which we can see, and definitely the downfall will get arrested because the stock price has already seen a correction and now they all have taken a price hike. So every player has taken a price hike. So it neutralizes the competitive intensity to that extent. But having said that, the competition in the paint space is getting more, hotter, and it will be difficult for paint companies to command the valuation premiums which they used to command. So the revenue run rate growth organically and inorganically put together can be 12 to 15%. And with your cap on the pricing ability and the input prices are panning out. So just for a trading play, it can be there up for 3-4% more on the taking. But structurally, I think they are in a spot, and time-wise correction is what will happen out there.
Okay. By the way, IT earning previews have already started coming in. We've got about 2 weeks, but the first of the IT previews is out. It's from JP Morgan. and it's come even before the quarter has come to an end and we have the actual INR rates. But they're saying the focus this time is going to be on the annual guidance because there is so much pessimism surrounding Indian IT. People are questioning the long-term relevance of the Indian IT industry, and therefore they believe that the companies the guidance is going to be critical because that will signal the growth acceleration or any sort of confidence. Not that JP Morgan's expectations are very high, so they're only penciling in a 2 to 5% revenue growth for Infosys in terms of an annual guide for FY27, HCL Tech 3 to 6%, and for Wipro, Q1 guidance will be -2 to 0%. They're saying Q4 should be a healthy quarter, but below earlier expectations for some of the companies. And those numbers will also come up for you on your screen. So for TCS, 0.6%. For Infosys, HCL Tech, Wipro, it will be a negative growth quarter. Some mid-cap companies like Persistent, Tata Tech are likely to fare well with a 4.5% revenue growth. Now, JP Morgan believes that the Indian IT companies are going through 3 phases that any company, when there is a technology change, goes through. The first phase is deflation, which is where they are in currently, when the loss of revenue due to the new technology overpowers the incremental revenue that comes in. That's where we are currently. Then comes digestion, where it sort of balances out. And then comes the reflation, where the new work, because of the new technology, kicks in. And they think, at least as of now, we don't know the timing at which the third phase will come in. So which is why they've lowered expectations. They're saying large caps over the medium term will only grow at 3%. Earlier expectation was 4%. Mid caps will grow at 5%. And they're saying it's going to be a while before the companies can get back to their long-term average growth of 7 to 8%. They don't see that happening in the near term, which is why they've cut the target multiples. That said, they do expect the rupee depreciation to cushion some of the earnings downside, but they haven't mentioned the extent to which the INR depreciation will play a role. But just wanted to highlight that's JP Morgan note. Today, of course, the sector is doing well. It's up nearly 2%. Across the board, you are seeing some gains coming through in the large cap names. Dharmesh, pick and choose any stocks that look attractive to you. Orient Pro is a stock that you've liked in the past, but have you widened your ambit to include any other IT names or any which you've not bought, but they are looking attractive to you or interesting to you?
Yeah, I mean, on the IT space, a couple of things which are playing in the favor is one is the steep correction has already happened. Second is a currency depreciation, which is playing out. And third part is most of these IT companies have announced their collaboration with some AI. And through that, they want to, enable all their products with AI feature being built into it. So by all the points of JP Morgan, which they have highlighted, and that the annual guidance which they give when they outlay their quarterly earnings will be very critical to watch forward to. And their body language and how much emphasis they are giving on the adaptability of AI-enabled features and the scalability of that. Having said that, the third point which they have highlighted that there will be a reflection point and from where, again, the growth and the margins will come into play. That is where I have my own doubts on. So as of now, Rima, I mean, we do expect some, because of all these factors playing out, there would be a currency depreciation already in the swing. There will be some trading play out there. 5-10% can be the at best, price appreciation out there. But we have not, widened the coverage. In fact, the coverage which was there on Persistent, Coforge, we have stepped out of that. But we are maintaining Orient Pro Solutions as a coverage on there, and we have a buy rating on that. They have won recently a big order of 350 crores of data center as well. So those put in place, we'll see the quarterly update on Q4, and then we will take a call. But largely, it seems unlikely that we will be widening our coverage of these stocks.
Okay, the IT index is down 3% since the month of March. In the month of March, while the Nifty 50 is down nearly 9%. Moving on now to the other big story. Sources tell Money Control that private equity fund Blackstone held talks to join the consortium of Aditya Birla Group and US sports investor David Blitzer as a partner to submit a joint bid for RCB. Everyone's watching that. The IPL begins this Saturday. Ashwin joins us on the phone line with what he's picked up about RCB and in whose hands it's going to go to. Ashwin?
Good afternoon, Rima. So, these are indeed the slog overs of this fascinating M&A tussle that is playing out as far as the ongoing sale process for Diageo-owned Royal Challengers Bengaluru is concerned. Remember, it's Diageo's arm in India, United Spirits. So RCB is a subsidiary of that entity, and that's the connection to the parent Diageo. Now, what we're picking up from our sources is that the world's biggest private equity giant, that's Blackstone, they have held talks to join a consortium of the Aditya Birla Group and David Blitzer. Who's David Blitzer? He's a prominent and widely respected American sports investor. So that's what we're given to understand, that Blackstone could potentially join that consortium. In fact, there could also be a fourth player who could join that consortium. So that's one point. The second point that we need to keep in mind is that the ArcelorMittal promoter family, that's Aditya Mittal, he's leading the interest as far as the sports bets are concerned. They are also likely to throw their hat in the ring for RCB. Now, these are the two new bidders that have emerged this week. But let's not forget, this is potentially a four-way race, because last week there were two other bidders that had thrown their hats in the ring. One was the consortium of Manipal Hospitals, Dr. Ranjan Pai and KKR. And the second one was Swedish private equity firm EQT, which decided to join hands with Premji Invest, which is the family office of Wipro founder Azim Premji. So we are now looking at a potential four-way race between these strong consortiums. The ask on the sell side since the beginning has been around $2 billion, but suitors are of the opinion that the team could be valued anywhere between $1.5 to $1.7 billion. But those were earlier expectations. Now the competitive intensity has gone up, and who knows, these consortiums may be willing to pay a premium, maybe in fact even more than $2 billion. But we'll have to wait and watch for that. For now, ArcelorMittal has declined to comment. We are awaiting a response from Birla Group and Blackstone. Fascinatingly poised right now, guys. Back to you.
Yeah, no, absolutely. And Ashwin, thanks very much for that. So there's global interest, right? I mean, and some of these names like Blackstone, the biggest of the big out there. Dharmesh, this is, of course, what does it do for interest in the space? And of course, I mean, listed companies, right? There's this one, but there is also CSK, India Cements, etc. in play. So just your thoughts, if you've put any value, assigned any value based on these IPL franchises.
Prashant, it's more of a one-time kind of a gain. It's not a recurring income. So, I mean, the valuations can be very high. I mean, let's see how it plays out. But as far as United Spirits is concerned, the business is not panning out that well. I mean, the competitors are giving it a tough stance, be it Radico and the others in the foray. And until, the business picks up, for us as an analyst, it doesn't make much of a sense on a long-term basis. But one-off games can always be there, and some trading bump up can be seen. So in the split space, we like Radico, Khaitan, followed by Tilaknagar Industries. That is where we think the real money can be made, because their businesses are doing pretty well, and their product launches are also doing fairly well.
Okay. The other story that my colleague Yash had put out is on Cello World, where the promoters of Cello World are looking to sell a controlling stake in the company, and feelers have been sent out to Blackstone, Temasek, Advent, Amundi and Kedara for a potential acquisition of a stake. The stock is up 2% today. But Dharmesh, this is a stock which has done nothing. I remember the listing. It was towards the end of 2023. The issue price was 600 plus. The stock today is down to levels of 400. It's gotten hit hard, 35-40% lower than the issue price. Valuations were expensive to begin with, but after the correction, how does the stock look?
I mean, it's more of a flattish kind of a story unfolding. I mean, on the numbers front also, they have not done anything great out there. And it's, very interesting at the same time, very surprising to know that promoters want a heavy exit from the company. So why they are doing so, it also puts a question mark on the business, because if financial promoters are going to take over the control of the business. So historically, we have seen wherever it has happened, the company has not, performed that well. I mean, the case in point being, if I may say so, the fight between Eternal and Swiggy. So Zomato has performed far better than Swiggy. So we as a house, we like, promoters who has a thick and skin into the game, rather than being financial promoters. So this is one more negative to my mind for Cello World.
Okay, 648 was the issue price for Cello World, and now it's at 400 rupees. That's a 38% decline from the issue price, and the stock has been listed for a little over 2 years. Thank you very much, Dharmesh, for joining in. One more stock, Urban Company, is seeing some buying again towards the end of the trading session. Urban Company is now up close to about 4.5%. Motilal Oswal today has initiated coverage on urban companies. They're saying it's convenience at a pricey valuation. Neutral call. Target price on this is 125. Stock is at 115. They're saying the home services marketplace opportunity is about $60 billion, which the company is trying to capture. Get into a break. On the other side, Varun Goyal, Senior Fund Manager, Mirae Asset Mutual Fund, joins in.
Welcome back. Varun Goyal is Senior Fund Manager, Mirae Asset Mutual Fund. Varun, good afternoon. Good to have you with us here. Thanks for joining in. We're getting a bit of a bounce today, so it's looking better. 22,900 nearly, not at the day's high, but not looking all that bad either. You know, irrespective of this war now, whatever happens, what is looking attractive fundamentally and valuation-wise, Varun, now? Which pockets? Because you know, we've heard this from others as well. So would love to hear your thoughts. If you want to go down to stocks, that'll be great. But do whatever you can.
Yeah. Good afternoon, Prashant. Thank you so much for having me on the show. I mean, the way we are thinking about it is that it's a temporary disruption of 1 to 2 quarters from an earnings point of view. And if you look at, in a lifetime of a company, or 1 or 2 quarters earnings should not lead to a 25 to 30% price damage. And in a lot of cases, we have seen price damage either equal to that and more than that. So I think as a market, overall, we have seen significant value emerging. I think if you look at, let's say from a bond yield versus the earning yield gap, I think for Nifty, that gap, with a bond yield at 7.8, you're looking at sub 2%. And historically, whenever that gap has gone below 2%, the subsequent 12 months should, have turned out to be very positive for the market. So I think, and I think this number looks even higher for the small cap space. So I think across the board, we are seeing, opportunities emerge. Yes, there can be dislocation for next 1 or 2 quarters, but I think several sectors have beaten down quite a bit. There's widespread fear of NPAs and credit costs going up, and that's why we believe banks and NBFCs have corrected quite a bit. In our view, it is unlikely to be the case that we see such a large damage, so we're clearly positive on that space. I think auto and auto ancillary, again, as of now, we see demand holding on quite well, and we believe that the OEM sales numbers will continue to be robust, and therefore that sector again looks pretty interesting. And I think there are several bottom-up opportunities across sectors, where we have seen significant price damage, and therefore I think for medium to long-term investors, this is a good opportunity to add up to their portfolios.
Have you spoken to any auto ancillary companies? Anyone at Mirae? They're looking to hike prices effective 1st of April on account of raw material costs. Will that in any way dent the volume growth, the recovery? And if once the earnings come out and there is a decline in the earnings, so some pressure that we see, earnings miss, is that a buying opportunity?
Yeah, so Rima, there are 2 ways to think about it. I think at this point of time, the economy is fairly well stimulated. We have seen significant monetary and fiscal stimulus in the last 12 months. So as of now, our base case remains that the demand will continue to hold. In fact, for all the industries which use crude or gas as a derivative, we'll see price hikes across the board. Whether it's paint, whether it's auto, and several other sectors. And some of that, if the consumers are willing to pay for that, that would kind of take away a lot of these concerns about margins and volume growth. So of course, we have to wait and see what eventually is the impact. But if this crisis is short-lived, 1 or 2 quarters, then broadly we believe the numbers will hold up. And as such, these are great entry levels to add on to some of these names.
Any other sector or theme that you'd like to highlight, which is attractive now after the correction?
So I think broadly the CapEx theme remains interesting. I think what we have seen is that hard assets will continue to see fairly good earnings growth, whether it's power, infrastructure. I think with the current geopolitical scenario, defense remains a must-have kind of a sector in your broader portfolio. So I think that's a theme which will come back. We have seen almost 6 quarters of correction and consolidation, and a lot of valuation froth has gone away from the CapEx theme. And we believe that incrementally that sector will start to do well. If you look at healthcare, I think that sector earnings remain unimpacted. Now, I think a healthcare space like hospitals, diagnostic labs and all will continue to see fairly robust earnings growth. And while there has been price damage, we do not see any significant impact on earnings. So some of those domestic-oriented stories, even domestic formulations as a theme should continue to do well.
Where do you stand on private sector banks, particularly what we've seen in the case of HDFC Bank?
I think broadly, for Tier 1 banks, we believe that the correction has made the entry levels fairly attractive. If you look at the credit growth, it has been holding on quite well. I think last fortnight, you're looking at 12-13% kind of number. Even if there is some cool off and we remain 10-11% kind of system-wide credit growth, most of these Tier 1 banks should deliver a mid double-digit kind of earnings growth. There is no sign yet of a credit cycle. We don't think this crisis can lead to widespread increase in NPAs and credit costs, and therefore we believe that the sector remains attractive for medium to long-term investors.
Yeah, got that. A base case is that demand generally remains same. By the way, Varun, have you looked at the real GDP growth forecasts from Goldman today? They're at 5.9. I mean, when you get to the 5 handles, it's a little, and of course, it's all contingent on when the war ends. But that's not great, right?
So Prashant, as you rightly said, it's contingent on how long this lasts. So if I were to go back to COVID times, right? So let's draw a parallel. At that time, we corrected 40% from the peak, and within 6 months, the markets went back. And I think the dislocation this time should be much less severe than that. So fundamental way in which I would look at this crisis is that, even if your earnings are badly impacted for 1 to 2 quarters, if you do the DC evaluation of a company in its lifetime, that is a few percentage points of its overall value. And therefore, there is no reason for a lot of these stocks to correct 20, 30, 40%. So I think that's the fundamental premise. Yes, in the short term, will we see increase in fiscal deficit? Can crude oil prices and energy prices stay elevated for next 2, 3, 4 quarters? They can. And that will have some bearing on CAD, that will have some bearing on fiscal deficit. But I think a lot more than that has been penciled in.
Okay, got that. Thank you very much, Varun, for that. Appreciate it, and good conversation. Well, Hormuz is here with the spotlight on the top movers in the market. Hormuz, tell us more.
The kind of moves that you are seeing on the benchmarks, you'd want to put some of the spotlight on the beaten down names on the index. But start off with a broader market name first. NOSIL is one name that has been making waves over the last couple of days now. It's significantly off the highs of the day, still up around 4%. It's the second straight day of gains. It has gained in 7 out of the last 8 trading sessions. Now, in this 8-day period, the stock has gained well over 30%. And the volumes in the last 2 sessions have been the highest on record. And even in today's session, we have had more than 7 crore shares that have been traded on NOSIL compared to a 20-day average of just around 40 lakh shares. And 9% of those shares have been marked for delivery so far. And today's turnover is around about 2/3 of its free float market cap. The turnover has already crossed close to 1,300 crores among the most traded names on the small cap index in today's session. The index name I wanted to put the spotlight on is Asian Paints, and the biggest single day gain in the last 4 months now. Volumes, well, they've been okay-ish. 12 lakh shares have been traded. The 20-day average is around about 9 lakh shares, 8.5 to 9 lakh. Around about 40% of those shares that have been traded so far marked for delivery. The stock is below key moving averages. The stock had fallen to a 52-week low yesterday, and from there on it staged a bit of a rebound, is up around 4.5% today. And despite that, it's still down around 20% for the quarter so far between January to March, and it is turning out to be the worst period it had since October to December of 2023. And lastly, Alkyl Amines is the top gainer on the Nifty 500 today. This is the biggest single day gain since April of 2020, so the biggest move in 6 years. Volumes are the highest in 3 months, and the volumes have seen a very sharp jump after 2 p.m. It's almost a one-way vertical move upwards. 20 lakh shares have been traded so far on Alkyl Amines, most of which have come in the last 60 minutes. The 20-day average is only 41,000 shares, and 15% of those shares are marked for delivery so far. The stock is nearing its 50-day moving average, which is at 1483. This still remains below key levels, but the kind of underperformance that the stock has seen, even after this move, the stock is still down for the month of March and is now reported losses for 9 consecutive months in a row. Today's session, though, belongs to Alkyl Amines, 17% higher.
Thank you very much for that. That stock is down 37% in the last 3 years. So the underperformance is not just for the day or for the last 9 months. It's been underperforming now for the last 3 years now, 37% lower. But of course, as you said, the day belongs to Alkyl Amines. Some more stocks then, just to run you through some of the action that's taking place. On the way up, you've got Tech Mahindra building on gains. That's up nearly 4%. Buying emerging in Dr. Reddy's. Apollo Hospitals has been a big mover. Citi today added Apollo Hospitals to their focus list for Pan-Asia. So Apollo Hospitals has been higher. Pan-Asia focus list as a buy because they say this business, the hospital business, is structurally resilient. That's reason number one. A fast-growing pharmacy business with digital profitability in sight. And the third reason they say for Apollo Hospitals is valuations which remain below long-term mean on an absolute and relative basis. So Apollo Hospitals is a big mover. But Mangalam now joins in to get us the latest trends from the F&O space.
Well, less than half an hour to go for the market close, which means that this is the expiry run that we're seeing for weekly options expiry. The Nifty is doing extremely well, closing in on that 22,900 mark, meandering around that. A large part of the up move was led by some of the call writers who covered their positions by being caught on the wrong side. Now, the IT stocks and the Nifty Bank together doing well for the frontline index is holding well. The only couple of things that we need to watch out for from here on, the India VIX still at elevated levels of 25. Yes, it is off highs given the sort of move that we've seen already. But, it does tell you that maybe the up move that we are seeing is tentative and may not see a big runaway move until the India VIX cools off. So that's something that we will track. The other factor that would make bulls feel happier is a lot of these index heavies contributing to today's gains. HDFC Bank, L&T, Infosys, however, they've all been underperformers in the past. So does this rally mean that it's just a bounce off the lows, or there could be more from here on, is something that we will be tracking. As of now, ahead of expiry, the call which is most active is 23,000. Writers on that may not get a lot of premium at around 3 to 4 rupees for the next 20 minutes or so. So maybe there's some bit of punt buying which is taking place out there. So let's see how that pans out right now. The premium is all but eroded on the 23,000 call that expires in 20 minutes from now.
Absolutely. Mangalam, thanks very much for that. We'll take a break. We're back with a quick check on what's happening with dealing rooms. So Nimesh joins in for D Street Chatter. And of course, with some trading ideas coming up after that as well. Okay, well, D Street Chatter is the segment right now that we're going to focus on. Nimesh is joining in with what's the buzz and what kind of flows will we see when we get those flows? Will they correspond to this 400-point bump, Nimesh? What's the chatter?
Unlikely, Prashant. So it looks like today's pullback rally is more so of a short covering rally, and that to in the crude beneficiaries. So that's the overall feedback. Of course, IT has helped the markets or the Nifty to bounce back sharply. But from a flow perspective, my sense is FIs are still better sellers and better sellers into the large cap names. So I need to see what the data pans out. But at least the initial feedback in the morning was that the FIs are better sellers. It won't be that large as what we saw, 10,000 crore plus. But a decent sell number is a sense that I picked up from the institutional desk. As I said, a bit of covering into the crude sensitive. So those are benefiting in today's market. Even the broader market seems to be seeing a bit of a pullback rally. Yesterday was a pure capitulation across the board, whether it's large cap, banking stocks, mid or small cap. I mean, looked like, yesterday there was a capitulation from retail, HNIs, the smarter fund managers, smarter investors as well in the yesterday's fall. A bit of pullback from those levels clearly because of the noise that we are seeing in the global market with regards to the geopolitical risk. Still, the risk persists, so not sure whether that's an end to it. But today's pullback seems to be more of a short covering rally and a bit of relief into the broader market names as well, because they looked extremely oversold.
Yeah. So this is mostly covering, and that too oil sensitives more than anything else. Nimesh, in terms of stocks, what's on the list?
Well, the first on my list is Linde India. We normally don't talk about this name, but It's buzzing in trade today. Big, very sharp recovery from yesterday's fall, up 8% last when I checked. Volumes also picked up. And for Linde India, the very near-term trigger would be the independent valuers report with regards to a potential merger between Praxair and Linde. That's been a long-drawn battle with the minority shareholders. As I said, the very near-term trigger would be as and when the independent valuer report comes out in the public domain. So that's the trigger for Linde India. The second name is Avenue Supermart. It's been consolidating in a very narrow range of late, but my sense is that the large selling from a domestic mutual fund seems to be largely over. And at these levels, a leading long-only FI has an active buyer of late in Avenue Supermart. And the third is CG Power. A big fall yesterday, a bit of recovery in today's market from the lows. And even in CG Power at current levels, at least some of the domestic mutual funds are actively buying into, and there are buy flows as well in today's market.
Okay. This the specific chatter which Nimish is picking up. Nimish, thanks very much for that. And more on some of these names a little later. Mitesh is with us with what he wanted to do. And Mitesh, what do you have?
Well, I think, one, we haven't got a total proper sign of a reversal, but it's not that the market is breaking down. It's holding out nicely. So we'll go with some long positions, given the fact that this could be the first day of bounce back. So KEI Industries is a BTST with a stop at about 41.09 for targets of 41.80. And the other stock, which I like, that's BTST on Lupin, which is closing above its all short-term averages. So BTST here with a stop at 2320 for targets of 2350.
Thank you very much for that. GMR Airports, that's the other one in focus. Kotak Institutional Equities has written a note on it. Vivek joins in with the details.
Well, that's right. So GMR Airports, one of the sharp movers in trade today, a very strong recovery from the recent selling pressure that the stock has seen. Kotak Institutional Equity has come out with a very interesting note. They've reiterated their buy stance. They've maintained their target price at 112 rupees a share. They've gone ahead and addressed three concerns that they believe has led to the recent sell-off. Number one, the ongoing Middle East or West Asia conflict. Number two, impending tariff outcomes from upcoming control periods of airports that it operates, as well as competitive airports. And number three, the potential competition as far as the Jewar Airport is concerned. Now, along with that, Kotak also says that the stock at this price, or the CMP, is not really factoring in any upside from positive outcomes of any of the legal proceedings that the company is currently embroiled in. Now, as far as the West Asia conflict is concerned, Kotak has gone ahead and tried to quantify the impact. They're saying anticipate close to a 7% cut in EBITDA in FY27, of assuming a one-quarter loss as far as passenger volumes from West Asia conflict is concerned. They say that over time, the real impact would be limited to just around 2%, given the fact that in the coming month, you will actually see a tariff hike, given the fact that the new control period comes into account or comes into effect. Now, along with that, they're talking about the control period tariff orders. Basically, for every 5 years, there will be a tariff that comes across. And they say that tariff orders for Jewar as well as Hyderabad is unlikely to impede the EBITDA growth. And last thing, remember, GMR is fighting various legal cases, and they believe that the market actually is not taking into account the fact that GMR is favorably placed to win a lot of these legal battlings, key amongst them being the TDSAT order on the DIL benefiting from the hypothetical RAB. So this is something that they believe can lead to a further upside as far as GMR Airports is concerned.
Thank you very much for that. But back to talking about the war. It's entered its fourth week. And every time, Prashant, we speak to investors and we ask them about how long this war is going to go on. And they said that with the midterm elections looming, they doubt that Trump would want a prolonged Middle East conflict, right? That seems to be one of the drivers. So how, you've done some analysis on the approval ratings.
Yeah, just it's simply putting up this data. It's nothing. It's just polling numbers for US presidents. So in that sense, there is no real analysis. And this is the thing, right? We've been talking about how the real trigger for winding down this war may be in America, right? With how popular or unpopular this war is. And as this data really tells you, there is no war bump. Usually when there is, and we've seen this because, we've seen many wars, over the last 25, 30 years, when a war begins, there is this general, bump that you get, this nationalistic fervor, rally around the flag kind of sentiment. but that is completely absent. Let me just tell you, right? This is the what you see in yellow here is the approval rating for US presidents 1 month before the conflict begins. And this is 1 month post the war starts. I mean, the conflict really sort of kickstarts. Of course, it's not been one month now, but this is the latest data available. You just look at this. The last 3 instances, which you can see, this is the Iraq War 2003. George Bush had 57% ratings. Its presidential approval rating went up to 69% a month after the war began. Back after 9/11, George Bush went from 57 to 89, right? There was tremendous amount of patriotic fervor and kind of sort of, support for the war, etc., etc. And that is George Bush Sr. Back in 1990s, the Gulf War period, 60% a month prior to that particular conflict. It went up to 74%. And now you look at this one, which is the Iran war for Donald Trump. I mean, his approval rating was already middling at 44%. And now that number is at about 42% or so. And that's the reason why I'm saying, I mean, unlike previous conflicts, and the data bears that out, there is no popular support for the conflict in the US in that sense. Gasoline prices are what they are. A lot of the MAGA base, which is Make America Great Again, America First, that support base is also a little angry and miffed, saying, well, this was supposed to be about getting troops from everywhere around the world back to the US and not starting new conflicts. So that's what I'm talking about. Politicians, give and take, everything, I mean, are the same, right, around the world. At the end of the day, they want to remain popular. They want to win elections. And this is not a popular endeavor which we are seeing, with regards to the conflict in the Middle East. I'm not saying based on this data you should believe that this conflict can't go on for another few weeks or perhaps even a few months. I'm not saying that, but I'm just saying that bear this in mind, that and this kind of, I would say, does tally, and this would perhaps be playing on the administration's mind as well. And we, of course, saw that tweet from President Trump. So while we watch the headlines, but remember, the underlying driver in terms of when this conflict winds down may not be actually in the Middle East and what really happens and who's got the upper hand, etc. It may be domestic pressures back home. Back to you.
Well, indeed, sustained low ratings could be a factor in deciding this Middle East strategy. Thank you very much, Prashant, for highlighting that. Let's invite Sudeep Bandyopadhyay. We've got about 12 minutes to go before we wind down trade. Looks like the Nifty is going to end comfortably with a gain of about 400 odd points, holding above 22,900. Sudeep, how would you read today's rebound? Do you see conviction in the up move today? Are people interested in buying after the ferocious correction of 10% since the start of the conflict, or it's still a bit iffy and skeptical?
It's still a bit iffy and skeptical. I think, today's rally or today's upward movement is definitely on the back of, probably we are seeing the beginning of the end of this conflict. But people are not sure as to how things are going to pan out, because we have seen what happened yesterday after President Donald Trump's tweet. Came tweets from Iranian administration and others, which kind of denied any negotiation. But I think there is something happening definitely, and that's the reason why market is expecting that probably this is the beginning of the end. And to an extent, this is why a bit hesitantly, but definitely there is some buying back in the market. At least the the ferociousness of this selling by the FIIs definitely has reduced. Also today being that Tuesday with the FNO closure, so there is some short covering happening, which is also contributing to the kind of mild rally which we have seen today.
And we've got back-to-back expiries because Thursday is a holiday. Thursday's expiry is now tomorrow. By the way, Dow Futures is down nearly 150 odd points. Sudeep, stay on. We need to slip into a very short break. We'll come back and continue our conversation. Welcome back. Winding down today's trading session in conversation with Sudeep Bandopadhyay. Sudeep, NOSIL is popping up on the price and volume charts. Yesterday, there was very large price action. Today, it's price and volumes, price less so, 1.5%, but very, very large volumes. Any idea what's happening here?
Overall, we have been positive again and again. We have been mentioning this, that this is one sector which was a completely bombed out sector. Last 2 years, the results were horrible. But if you look at the Q3 numbers, green shoots were clearly visible. The original logic of China plus one remains very much valid even today. And on top of that, I think the trade deals which we are in the process of executing with EU, as UK, as well as hopefully USA, will definitely help the business. As far as some of these companies, including NOSIL, is concerned, close to 50% of the production is exported to multiple markets. And these trade deals definitely help the cause. Overall, I think it's good time with orders flowing in from multiple geographies, and the criticality of Indian these manufacturers in the global supply chain is becoming more and more relevant. Of course, NOSIL is in a specialized niche segment, which demand is continuously increasing because of replacement of China, and that's what is happening generally.
TBO Tech is also seeing buying. This is a global B2B travel distribution platform, and perhaps it's been impacted on account of the airspace closure, some flight disruption. Stock today, though, is seeing some buying. It was weak over the last couple of trading sessions, but today on the back of that Motilal Oswal note, TBO Tech is seeing some interest. Apart from that, Sudeep, a lot of these platform companies, so whether it's Urban Company 3.5% up, Meesho 6%, Brainbees Solution for the last 3 trading sessions has seen unusually high volume activity. Any positive bias towards platform companies? If yes, which one? We've spoken about Eternal in the past, but if you want to talk about any others.
Eternal, definitely, so I will exclude that. The other platform company which I like for quite some time has been Delivery. Unfortunately, it didn't perform as per the promise which it had shown initially, even before listing. But I think things have started improving there, and the business has stabilized. The recent acquisition which they made is also going to be revenue accretive and profit accretive as well. So we are definitely positive on Delivery. As far as Grow is concerned, again, we have been very positive on Grow. Capital market, because of all of the turmoil which is happening, it was under pressure. But we believe that there is a secular tailwind behind Grow, and this is going to go places. Look, they're the largest in terms of number of customers they serve on the equity segment, but the opportunity for them to expand on loan against shares, margin funding, as well as wealth management, I think it's significant with the customer base they have. So we are looking at different revenue drivers and different profit generators going forward. So we are positive on that.
Yeah. Sorry, which is the pick out of the lot, Sudeep, you said?
I said, Grow. We said that Delivery. These two, apart from Eternal, of course.
Yeah. Have you looked at HDFC AMC in this current fall?
I did. While we overall like the AMC space because financialization of savings is real, but I think the valuation still looks a little rich as far as most of these AMCs are concerned. So we would rather play the financialization of saving through some of the companies like a Grow or even the exchange space, which we believe will get even more exciting when NSE comes for listing in the near future.
Sudeep, we'll end today's conversation for now. Thank you very much for joining in. We'll continue chatting with you in Markets Forward. Winding down today's trading session, it's a good one. The Nifty is ending above 22,950, a gain of 450 points. Sensex has surged nearly 1,500 points. The key driver was that 5-day ceasefire that Trump announced when it comes to attacking the energy infrastructure of Iran. But we had a gap up opening. Markets built on that. And that, I think, is a positive sign. But this comes after many, many days of consecutive losses from the start of the conflict. Benchmark indices were down nearly 8%. Run you through the big movers. Tata Motors right on top. That's passenger vehicle, 6% gain. Stocks benefiting from the decline in crude prices like an Interglobe Aviation and Asian Paints higher in trade. L&T was a big mover, 5.5%. Eternal has been seeing buying for the last couple of trading sessions. NBFCs like Bajaj Finance, Shriram Finance, Hire and Trade, Ultratech Cement up and about. HDFC Bank, which has appointed external lawyers just as a proactive step in terms of corporate governance. HDFC Bank saw some buying. On the way down, some PSUs like Power Grid weak. Coal India also, I think, had a cut. That's the top loser, 3% lower on Coal India. And Cipla, Sun Pharma, capital rotating out of these defensive pharma names, which did well. And now it's moved on to some of these high beta names. So all in all, it's a good close. And the Nifty ending about 100 points shy of their all-time after intraday high levels, but still very, very strong, 2% gain.
That FPI number, Rima, later today when it comes, right? Nimesh was saying, well, his sense is it's going to be not great. I mean, this is largely short covering, etc. But we'll see when that comes out by about 5:30 or so, what that really looks like. But yeah, I mean, this is a good close and looking down and out yesterday, and we're back up a little bit. So actually, I think we are ending where we started. Let me just quickly see. The open was 22,878, and we're higher, right? We're at about 22,960 or so. So this is 50, 60 odd points above where we started this morning. It's not a bad outcome. At one point, it looked like we'd be left with little on the board. At one point, we were up just 1% on the day. We end with just almost 2% right there on the index. So 4:1 in terms of advances to decline ratio. And lots of action in the broader market, broader space, etc. So that's the market for you this Tuesday. Back to watching headlines, watching social media handles and whatnot, right? I mean, that's what tracking markets has come down to, but it is the way it is for now. It's a wrap from all of us here. Thank you very much for staying with us. More coming up on the other side. Markets Forward will prepare you for tomorrow.